Hello and welcome to another episode of Trust Issues. Today I'm sitting down with Thomas McMahon, Head of Investment Companies Research at Kepler Trust Intelligence, to talk about BlackRock Frontiers. We're going to share our thoughts on the trust, including BRFI's investable universe, current sector and geographic weightings, recent performance and long-term growth drivers for frontier markets. Thomas, many thanks for joining us today.
Hi, Joe.
So could you start off by providing an overview of the trust and its investable universe?
Sure. Well, BlackRock Frontiers, as the name suggests, originally invested in frontier markets. It was launched in 2010, but since 2018, the investment remit was broadened and changed, and it's now a very unique proposition. The trust invests in the entire frontier and emerging markets universe, excluding the 8 largest countries by market cap. That means China, India, and a number of the other largest economies. So what this means in practice is that it invests in countries which form pretty much no part of the main emerging market indices, and they're 4 of the typical investor's portfolio. It's managed by Sam Vecht, Emily Fletcher, and Sudhaif Niaz. They've all worked on this product or similar products for a long while, and together they have an combined experience of more than 50 years.
Thank you. And drilling down into the detail, what attributes do the managers typically look for in potential investments?
Well, this is a very broad universe with lots of countries that are often driven by endogenous factors, so very much by growth under their own steam rather than global factors. And so an understanding of the economies of these countries is really important. BlackRock, as the world's largest asset manager, is well placed to cover such a broad universe, and the teams there maintain economic models of all of the underlying countries. And this directs Sam and the team to where they should be looking for ideas. But bottom-up analysis is also very important. The managers are looking to buy the right stocks to benefit from these economies as they come into a good point of the cycle. And when it comes to stocks, what they're looking for, what you might typically call quality growth stocks. So those are companies with stable earnings, good cash flow, and strong balance sheets. It's important to note that the team travel widely to meet management teams and to understand the corporate and regulatory ecosystem. And again, being from BlackRock and the world's largest asset manager gives them good access to local stakeholders.
Fantastic, thank you. Moving on to the current portfolio, can you provide an overview of current sector and geographic weightings?
Well, it's normal to see the portfolio have a high weighting to financials, and that's true at the moment. And this is because, firstly, banks in particular, but financials more broadly, are a great way to gain access to the broad economic growth in an economy, and therefore to capture the growth as an economy pivots into a positive part of the cycle that we spoke about. So over the last financial year, examples would be picking up positions in OTP Bank of Hungary or banks in Asia, such as in Indonesia, trying to harness the growth potential that the managers see at this time. By geography, so I think an important thing to understand is that the universe can change in its composition year on year quite significantly because these markets are quite small, and so rapid growth in one and rapid decline in another might lead the benchmark to move around quite a lot. If we look at the portfolio at the moment, the largest weighting is to Indonesia, which only makes up a matter of 1 or 2% of the MSCI emerging markets. Indonesia is really benefiting from its natural resources, in particular nickel, cobalt, and these minerals that are very important for the electric vehicle industry. This puts it in a really strong position when it comes to trade with China and the US. There's also a very significant position in Saudi Arabia, although this is underweight the benchmark and has been for some time, and indeed more broadly in the Middle East, such as in the UAE. Together they make up a significant part of the portfolio. With regards to Saudi Arabia in particular, a lot of the opportunities are coming from the government's attempt to broaden, diversify the economy away from oil and gas in the light of net zero. And at the moment, there's also significant weighting to the Philippines, which the managers think has an attractive outlook at the moment. And so they've got a significant position there. But it really can be quite diverse month on month because the underlying universe is so broad. So over the past year, we've seen some of the smaller countries in the universe come back into the portfolio, which haven't been held for some time, such as Egypt, for example. So, it can really change over time.
And moving on to one of the specific characteristics of investment trusts, what's the current level of gearing?
At the moment, at the time we're speaking to you, the gearing is pretty much zero. But generally speaking, the trusts have been modestly geared throughout the year. When it comes to the gearing, it's important to note that it doesn't really reflect an overall call on the markets. It tends to be driven more by the opportunities that the managers are seeing. At the moment, the low level of gearing is more about a mismatch of buys and sells. So they've taken quite a lot of profits in some really strong performing positions, and they've got some ideas and they're researching other ideas. But there's a bit of a lag between generating those ideas and filling those positions, which is particularly the case in some of the more liquid markets where they're looking at the moment. One thing to note on the gearing is that it's taken through contracts for difference, CFDs, and that allows the managers to get exposure to an asset without actually owning it. It's a form of derivative contract. They can take short positions or long positions, and long positions obviously result in a geared position.
Investors considering an allocation to frontier markets may be keen to understand how the trust manages risk, both in terms of volatility but also geopolitical risk.
Yeah, politics is a difficult one, but again, it's a case of really devoting a lot of resources to it. So that means considering it within the investment process. And also, it's a matter that the managers consider when they do their extensive trips, pretty much literally around the world, to visit these countries. So they certainly place a lot of weight in understanding the politics of countries. This can lead to opportunity. Change of government is often a catalyst for economic growth. For example, Bangladesh, the managers became positive on over the last financial year after a government change in August. But of course, it can also be a cause of danger, if you like, for investors. And the team certainly put a lot of effort into trying to understand where these risks are. If we consider volatility more broadly, though, one of the interesting features of this investment universe is because the countries are so independent, so diversified in terms of what's driving them, because they're not really dependent on overseas investment and capital flows in the ordinary course of events. They don't actually have a very high degree of correlation to one another. So what that means is that even if the underlying markets might be quite volatile, BlackRock Frontiers NAV tends to have a lower volatility than the MSCI emerging markets, at least. This is certainly more the case in the smaller end of the universe and in the frontier markets, but it's true across the universe.
And moving on to performance, could you talk us through your thoughts on recent performance and some of the key drivers?
Well, over 5 years, the trust has performed very well versus the mainstream emerging markets investment in particular, outperformed considerably. The managers have also managed to outperform their own benchmark meaningfully too. If we look at more recent times, so in 2024, it's been a decent year, 10% or so at the time we're recording this in GBP NAV terms. The MSCI emerging markets has kept pace, on the other hand. It's been very volatile, as we know, around China, stimulus hopes, and so forth. But net, both MSCI emerging markets and BRFI have produced pretty similar returns. It's really interesting to see that the drivers of BlackRock Frontiers returns are extraordinarily diverse. So really backing up what we were discussing earlier, the best stocks have included a Turkish gold miner, a Vietnamese technology outsourcer, and then banks in Indonesia, banks in Greece, Poland, the Philippines. So really supports what we're saying about how it's very rarely broad themes that are driving BlackRock Frontiers performance. It tends to have some very diverse set of drivers. It's also worth noting that the dividend yield is quite considerable, and the yield is a byproduct of the investment process. The managers don't target a yield, and the board doesn't promise a high income or a progressive dividend. But nonetheless, the yield is considerable. Obviously, this moves around a lot with the share price, but at the time we're talking, the dividends for the 2024 financial year would amount to a yield of around 4.8% on the share price. So that's pretty handsome forward-looking yield too.
And why do you think this sector lends itself well to active management over, say, a passive strategy?
Well, first, let's just acknowledge that you don't really have any other option than active management in this space. There's no ETF offering exposure to the emerging and frontier markets plus Saudi Arabia, excluding the 8 largest countries. That doesn't exist. So it really is your only option. And secondly, these markets are under-researched. Lots of investors simply don't pay any attention to them. They're not researching, they're not looking for ideas, they don't invest in them. They don't feature very highly, if at all, in the benchmarks that form part of the typical ETF or passive funds that are increasingly popular. So the opportunities for active managers to generate alpha are much higher, particularly if you can bring a lot of resources to bear. Working in BlackRock with such deep pockets, lots of boots on the ground, access to companies and stakeholders in the countries, they really put a lot of resource into identifying ideas here. And that's led to good returns, and they've generated alpha through both country selection and stock selection in recent years.
Thank you. And one final question for you. What do you see as some of the long-term growth drivers for the region?
Well, first of all, I think in many ways you could consider BlackRock Frontiers as a very much a classic emerging markets fund. Why do people invest in emerging markets? Because they want the investment opportunities that come from the fast growth in emerging economies as they move up the wealth level to a much higher income level, closer to our standard of life in the West. And some of that's been lost in the mainstream emerging market index, I would argue, as China's developed so fast. And then you've got countries like South Korea, Taiwan, which are very similar standards of living to European standards of living. So, questionably, you can question whether they're really emerging markets. And their stock markets are driven more by technology, which is very much something that we can get in the US or developed markets too. So I think there's that, that really exciting growing wealth story that is going to be there for decades to come in Africa, Latin America, and the less well-developed parts of Asia. And a lot of that's being driven by population. So lots of these countries have very young populations, cheap workforces that are willing to work, and thereby they offer great labour forces for multinationals and the like. And so that's a driver of market growth there. And then finally, we should consider the political situation in the world. One of the supporting factors for BlackRock Frontiers over the last few years has been a lot of the countries it invests in can benefit from trade tensions between the US and China. As the world divides into a pro-US bloc and those who are more favourable to China, lots of these countries can really sit in the middle and trade with both the US and China. And they're often great places for Western multinationals to shift production if they're trying to avoid China. So, I think that shouldn't be underestimated, particularly with Trump entering the White House and his obvious antipathy to China, that I think a lot of these countries are going to continue to be in a strong position geopolitically.
Some really interesting insights on investing in frontier markets. So, Thomas, many thanks for joining us today.
Good to speak to you, Joe.
I'd encourage you to visit BRFI's website to find out more information about the trust, including their latest fact sheet and insight articles by the managers. And we also have a wealth of information available on the Kepler Trust Intelligence website, including Thomas's latest research note on the trust. Many thanks for listening, and we hope you join us again soon for another episode of Trust Issues.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.